Hey everyone, welcome to the KE Report in a daily editorial. I am chatting with Darrell Fletcher. Darrell is the managing director of commodities over at Bannockburn Capital Markets. I chat with Darrell on more of the trading desk side of things, getting his insights on some of the major commodities. We're going to talk copper, which is continuing to hold over 520. Nat gas, which has just dropped below $4. Oil, still a very boring market, just under $70 a barrel. And gold, I'm curious to hear what Darrell has to say on gold over $3,000 an ounce. Darrell, I do want to start with copper, though. Copper has almost been in this stealth run higher. Seems like a lot of this has been driven by more geopolitical news. Boy, oh boy, it seems like all we can talk about when it comes to markets is what Trump is saying and what potential tariffs might be. We also had an executive order recently signed to accelerate critical mineral production in the U.S. Darrell, as you're looking at this copper market, what stands out to you?
Yeah, thanks, Corey. This is definitely playing out like we thought it might. The tariff situation clearly has more of an effect on the metals market, for North America than say crude or natural gas. Natural gas is still pretty grounded by weather. But the metals, yeah, the three I've been following really closely are these differentials of US markets to the world markets. Copper, COMEX over LME, copper hitting an all-time high, and that gap just keeps growing. Aluminum, Midwest US premium is up 80% this year. And the LME, the aluminum on the LME 3 month is only up a couple percent. So again, the differential of the US premium here now with tariffs. And then the third one I follow is hot rolled coil steel, which is a US basis. It's up 28% year to date. Conversely, iron ore is down a percent. You're back upstream a little bit on that, but those are the three differentials that have been really telling, and they're all in the metals markets. It's been interesting.
So, Darrell, these differentials, is it simply telling you that maybe because of these tariffs, the U.S. is starting to stockpile these different metals?
Yeah, similar to gold, silver, copper, there's a lot of the warehousing, the physical coming in, trying to get ahead of these tariffs. So you've seen it in all three of those. And then today, there's another announcement for what it's worth that they're going to accelerate the copper tariffs. It was kind of a matter of time. And that's why copper's been going up all year on COMEX here in the US. But they were talking about now pushing the copper tariffs, whatever they may be, up to just 2 or 3 weeks from potentially what was thought to be 2 months. So again, today, interesting day. Copper on COMEX is up, not as much as it was this morning. So it's like 520, but you've got copper on LME 3 month down 2% today. So this differential is about 80 cents a pound. This is huge. It's an all-time high of COMEX copper over LME cash, about 1,750 a metric ton. So it's been interesting.
Darrell, I find this so interesting. When we're talking tariffs, a lot of people accept the tariffs are simply inflationary. Some people argue that it's a one-time price adjustment. But fact of the matter is, when tariffs are put into place, it does seem like prices, especially when it comes to commodities, follow those tariffs. If it's a 25% tariff, it's reasonable to think we'll see a 25% bump in price. Is that how you're following this market too? Is that if tariffs are enacted, if they're increased, look at what the tariff is and assume price is going to follow to almost that exact extent?
Yeah, that's a great observation. And on the surface, COMEX copper is up 30%. We're talking about 25% tariffs potentially. So there's a correlation there for sure. Clearly, it gets absorbed down. I think there's a lot of studies around tariffs, not the full effect falling down, but it's certainly a tax. It's a hike. What's impressive to me on copper, I keep looking at it, is front month's up 30%, but the forwards are also up. You're still in a contango curve. So and that's rare for a commodity to have this big of a move in the front and the rest of the curve also lift with it. And I mean, it hasn't flattened. I think you're like 550, 560s going out. So that tells you that the market is structurally changed here, at least for the time being, across the board on copper.
Now, when we talk about this executive order, too, to accelerate critical mineral production in the US, how do you view this? Because what I keep hearing is yes, there are resources in the US, in Canada as well, but the problem is there aren't any refineries. So, yes, you can pull some of this material out of the ground, but you still need to mostly ship it out east to get it refined. How do you view how these executive orders or this executive order could increase or just impact broadly the production of copper, let's just say in the US?
It's a great point. Theoretically, yes, directionally it should, but let's talk about the time lag. I mean, two things. One, to get a new mine up, say you're going to relieve, restrictions around how quickly you can get a mine up, you're still talking a big lag. And then to your point, you still have to have refining capacity. So, we were talking about this earlier on the aluminum side. There hasn't been a new smelter in aluminum built in the United States in 35 years. There's reasons for that. It's not easy. And yeah, so there's a big lag. I mean, directionally, yes, but it's TBD at best.
So, Darrell, what does this mean for the companies then? Because, quite frankly, the copper stocks have lagged this move, especially when you look at what the US market is pricing in here. I realize there's, again, that big differential, but the stocks have lagged. Is that telling you something about the sustainability of this rally, or does it further confirm to you that, look, this is so politically focused that sometimes the stocks don't react to that stuff?
Yeah, it's interesting. I was looking at COPEX this morning, or even if you look at FCX, some of the bigger miners up 10, 12% year to date, and you have, like a 30% move here. Now, those moves are actually more in line with LME copper and the move that it's had. But it's a couple of things. I think equities have been hit here in the US for sure. So as an asset class, you're going to get some dampening down. And then I don't know, I mean, maybe it's just a matter of it'll take some time for it to catch up. And mining's not an easy business. I mean, I think Glencore halted some production this week out of Chile on a fire out of one of the big mines down there. So there's, things can go wrong, as you know, in mining. But it's definitely the move has lagged the headline if you look at just COMEX copper.
What have you seen in the positioning of investors then, in terms of, let's say, maybe the COT report for copper, where investors, especially the big money, is getting positioned here?
I haven't followed it super closely on copper. I'm sure those positions are up. I've been following natural gas a little bit more, and that has kind of peaked out in mid-March on the positioning. But I mean, clearly, you would think they're getting longer and longer, and the forward curve kind of supports that too, which is really interesting.
Okay. Well, what about China? How's China playing a role in this? We keep hearing how China's such a big consumer of copper, how they continue to stockpile copper, but really seems like right now, with what we're seeing coming into the US, is now it's more of a US driven story. So, how do you balance out the potential Chinese impact?
Yeah, the copper story is clearly this U.S. story. China, it kind of lost its headlines this year, finally, in the commodity space. But I think it's been a little bit more of the same disappointment over expectations and growth. You kind of see that in iron ore. The base iron ore contracts are down about 1% or flat this year, as opposed to like an HRC steel Midwest US premium being up about 20, 30%. But it's kind of flattish at best, and it's not the headline right now, and there's nothing really exciting coming out of there.
Okay. Well, copper, definitely kind of a stealth mood here, I feel like, where the price is, again, at historically high levels, all-time high levels, but no, only some people are paying attention to it. Let's talk natural gas. One thing we've been talking about all year is how natural gas has remained quite strong. It's recently dropped a little bit from its peak earlier this month, just under $4 right now, but again, you look at last year, hardly ever got above $4. So, what's going on in the natural gas space?
Yeah, it's been an interesting one too. Natural gas, I'll talk US basis here in Henry Hub. I call it a guarded market right now. It's kind of sat here around 4. We had a nice run towards 5, I think, and it was early to mid-March. That was a lot. There's some risk premium built into those fronts because there was concern coming out of February, early March that our inventory levels were going to fall to like a 1.5, 1.6 TCF, more in line with what we saw coming out of winter 22 into spring 22. And that's when gas took off in the summer up to $9. Now, what's actually happened is the end of March, temperatures have been moderate to a little above normal. Finally, maybe not where you and I live, as we were discussing earlier, but in general. And I think these last couple of weeks of March, we just haven't had the bills that they were really, or the draws they were concerned about. March is probably going to be a net build in inventory. So that's kind of rolled over that front contract. I think we roll over to May this week in natural gas, yeah, later this week, sitting around 390. But I call it a guarded market because the rest of your summer strip is still sitting around, 430. Cal 26 is at 440. So this front month's kind of just sitting here now, is guarded because we could pivot up really quickly higher because LNG pools have been strong, 15 to 16 Bs a day. Storage is still relatively low. 1.7 is 10% below the 5-year average, but it's just not that super low level they were concerned about. And production's been, I call it disciplined, 103, 105, 106 BCF a day. So those three things are all in play. Weather's weather. So it's going to sit here around four. Like you said, it's rolled down a little bit, which doesn't surprise me given the lack of weather the past couple weeks. And I think it'll sit here because they're going to see how quick of a summer and power generation pools are, and if LNG stays strong and if production stays disciplined, it could pivot quickly again. Specs, the speculative position moved really long in middle of March, and that has come off a little bit in the past couple weeks.
Okay, so Darrell, I want to get your insights then on those storage levels. As you said, about 10% below the 5-year average. We hear from a lot of the energy bulls that storage levels are low. That means that when summer kicks in and the air conditioners need to get turned on, that could cause price spikes. But hearing that it's 10% below the 5-year average to me doesn't scream that it's in a dire situation. So, look, you've worked at a lot of commodity trading desks. You've seen this thing year over year for many years. How should we view storage levels in terms of future potential price moves?
Well, I think it's the biggest fundamental as you cycle through the seasons is the storage level. And really, especially in tandem now with the fact that we export LNG, like a chunk, like a big piece of our production goes out now. So yeah, it's a big deal. And 1.7, 10% doesn't sound really low, but it's meaningful. Again, there was some real concern that we were going to be down to 1.5, 1.6 TCF. So it's a big deal. I think that the summer is going to be really interesting. You could, with this, if power gets off to a hot start, if we get, AC demand and infrastructure type demand, that's what everyone's kind of guarded about. I think end of season still looking around 3.7, 3.8, probably. Just really depends on how the producers produce.
Well, let's talk about that because you said supply has been disciplined. Look, we're at a higher price level. We have been here for about 3 months now, kind of over $4 or mostly over $4. In your eyes, what price level does it take for these gassers to really open up the flow?
That's a good question. It can be really basin specific too, but I just feel like the producers have been really disciplined about cash flow, free cash flow, not getting over levered. They don't Clearly they're not getting paid, to overproduce anymore. Those things have changed. So I mean, this level is going to be pretty steady production, but I don't see super aggressiveness right here.
All right, let's move over to oil, which has been kind of surprisingly still just a boring market with how much is going on in other commodity sectors. No one seems to care about the oil market right now. It's still just a little bit under $70 off its lows from a little bit earlier. But what's going on in the oil market here? Any break higher or lower that we're going to see?
Now, to your point, it's been kind of grinding lower and boring, which is odd for crude oil. It has not been the headline commodity. I think crude oil also has, gold in the opposite direction of it, but it has, uncertainty and economic concern. has kind of driven this lower. Fundamentals for supply demand are kind of bearish. OPEC Plus announced they're going to put barrels back on the market in April. Finally, they've delayed that for a while, and there's some further talk I thought I caught this morning about potentially another layer in May on top of that. So we've been grinding lower, which is kind of what I thought would happen this year. We're down about 3% year to date front month, and the market's backwardated. So if we're sitting 70 today on front, and calendar 26 is 65. So that kind of a bearish outlook overall. We had a little bit of a move up this week, just the US stocks drew and just some geopolitical stuff. But as you can tell in my voice, I guess it hasn't been the most exciting market at all.
No, it hasn't. Let's talk price levels though, because around that $65 a barrel level, it's been touched a couple times over the last few years. March 2023 was the last time it was there, and then we really have to go the whole way back to 2021. So that $65 a barrel level, it has been holding for a few years now, but we've been seeing lower highs throughout these last few years. How worried would you be for the oil price to drop below that level and see, who knows, dramatically lower oil prices potentially?
Yeah, that's a good point. We were watching that move in to test that move in September of 24 at 65.75, and that held, and it got pushed again here in the past month, but that's been holding up pretty well. Yeah, the technicals and the fundamentals are kind of bearish. So price level wise, you're going to have to break down below 65. If you break below 65, depending on the economies and global economies, if they're not running hard, you could push lower. And I think before you start to see some production come off. But I mean, in the near term, 65 is definitely the one to watch.
Oh yeah, just looking at that chart and it's getting tighter and tighter right around that level. It could be, who knows, if it holds there, maybe we could see a much increased bounce higher, but overall, man oh man, that's 65-ish level broken. There's a bit of air under there. So, who knows with the oil market, but something to closely follow. Let's also talk gold. Obviously a bull market for gold. Overbought on the monthly chart to extremes that we haven't seen since I believe 2020 and 2008. The market has been up 14 out of the last 18 months, and some of those down months have been very limited, mostly flat there. Gold over 3,000. What are you seeing next in the gold market, Darrell?
It's been a nice steady move higher in line with expectations, really. Once it broke over 3,000, it's been holding pretty impressively. Markets don't like uncertainty. So it's your safest bet out there. I mean, I can't take credit for this. There was a comment around gold that really caught my ear is that, it's the one thing that doesn't have counterparty risk theoretically. So when these governments are continue to issue debt and there's a lot of uncertainty around your strategic plans, I mean, gold's gonna do well. I don't see that changing. Silver too. Silver's up 16%. So it's been a nice steady march higher. And to your point, it's been consistent.
Daryl, is this just all about global uncertainty? We talk so much about it, and I feel like we have to talk about it because every month, tariffs, are they coming in? Are they getting pushed back? Are they going to be ramped up? The whole world seems to be in a pseudo trade war right now without a whole lot of clarity. Is that a key driver? Is that really the main driver that you're seeing?
Yes. Yeah, lack of clarity is playing out on the gold market. That's exactly what you're seeing. There does not seem to be a lot of strategic direction, shall we say, and so that with the tariffs to this point. So we shall see where it goes. But in the interim, I don't see this changing for gold or silver.
No, doesn't seem like we're changing the direction of these trade wars anytime soon. And hey, clearly gold has been pretty much the best winner out there, the best market to be in as this uncertainty continues to unfold. Well, Darrell, thanks for the update here. Always interesting to hear what you are seeing from the more commodities trading desk side of things. Again, Darrell Fletcher, Managing Director of Commodities at Bannockburn Capital Markets. Darrell, it's great chatting with you. We'll chat again next month.
You too. Thanks, Corey.